All right, we have more changes unfolding in the U.S. economy and in the U.S. housing market. Changes that have a surprising reality check hitting markets after the blow up month that we just saw. It turns out the reason for November's market melt up was all central bank induced. Wait till you see this. But even with the run up in stocks and bonds, it doesn't change the bigger picture. As two more investment banks just published reports saying basically, like the same thing, flipping on the U.S. economy. What does this make it now? Like four total, four big banks. We looked at two other ones late last week, all now flipping their stance on where the economy's headed, where the labor market is headed, and with that, where the U.S. housing market's headed. So we're going to look at what they just said, how one of them now projects the Fed's about to start cutting the night rate and doing it fast, and how all the proof that we need, they say, has begun to come out in the public data set. But before we get started, press the like button and consider subscribing. It helps the channel out, and I appreciate your support. So November's market melt up, folks. 9% on the S&P, 11% on the NASDAQ, all induced by central banks, it turns out. Stock market, if you weren't aware, no longer moves based on fundamentals, on company earnings. You could trace this phenomenon back 2 decades. It moves on liquidity, more specifically on reserves. And last month, what happened? $350 billion more in reserves were injected back into the system from the G4 countries and from the PBOC. But in the big picture, we have like other problems to worry about. Rate cuts, folks. The Federal Reserve cutting rates, coming out and announcing at the next meeting on January 31st, or maybe during the March FOMC meeting, that they are sufficiently convinced that inflation's low enough and the economy's slowing enough to begin lowering the night rate. Now, how likely is that to happen? Well, not likely at all, unless we see a massive slowdown in the U.S. economy. The type of slowdown that you see when you're in a recession, but it doesn't show up in the data yet. Realize most past recessions are only visible in the data after the revisions are released. So there's like a lag time to this, but there's ways, there's techniques to see if that's where we're headed. And according to ING, that's exactly what they're seeing is happening right now. Take a look at this. In a new report released on November 29th titled "A Cooling U.S. Economy Points to Swifter Rate Cuts," today's economic reports provide further evidence of moderating growth, easing inflation pressures, and a cooling jobs market. This should only confirm market expectations that the next Federal Reserve policy move is going to be an interest rate cut. Now, we're going to look at this report in a minute. And by the way, if you want access to our research database, I put the link in the description of this video. But first thing, why is this happening? Tighter lending conditions combined with these higher rates are a potent tool the Fed uses to slow the economy. It's a process though, all right? And we've been talking about this for the last year. Well, this process is nearing its end zone now. I spoke about this on Twitter this morning, actually, how it starts with the banks, right, writing less loans. The loans they do right have stricter terms and higher interest rates. You can see it on this chart. Ever since the March banking crisis, starting with SVB, look what happened to cumulative loan growth for U.S. banks. The red line is 2023, blue line 2022. What happened? It stopped. Large banks in particular realized what was happening and they got ahead of the curve, completely stopped lending. Small banks followed suit, which does what? It causes businesses to stop growing, stop spending on CapEx, on capital expenditures, and the companies with maturing loans are forced to save costs, which means smaller annual bonuses, fewer pay raises, and eventually even layoffs. The end result is people losing their jobs, like you see on this chart. It's more predictable and more reliable a tool even than looking at like the yield curve, for instance, or really at anything else. Debt makes the world go round, and each time banks stop lending, it leads to higher unemployment, as it has every other time that this happened. In fact, the unemployment rate is already rising. It was 3.4% 4 months ago. Now it's 3.9%. Anything over 4.5%, and things will look significantly different. That's around 1 million more unemployed people than we have right now. And what does that mean for the housing market, by the way? Well, it's what the Fed refers to as a period of forced selling or rebalancing. As unfortunate as that sounds, it's what the Fed's purposely trying to engineer. I played a clip of Jerome Powell saying as much a few videos ago, but in case you didn't watch it, here's another one saying something similar. It's only 20 seconds, and I realize, I'm playing something like this again, but I'm doing it because it has to do with this new ING report that we're about to look at. So take a listen to this.
That we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing.
Now that we're on the same page, right, that this is not only happening, but if we look at ING's new report, it's in the later stages. Again, this report's from November 30th, right, and it explains why they believe the Fed's about to be forced to start cutting the overnight rate soon. They write this: jobs market is cooling, not collapsing. We have had quite a lot of U.S. data today, starting with the initial jobless claims, which rose again last week. The trend, though, is certainly towards higher continuing claims, while initial claims remain low. Essentially, the message is that firms are reluctant to fire workers, but they are less inclined to hire new workers. More evidence of a cooling but not collapsing labor market yet. And you can see continuing jobless claims here. Realize once this starts to move higher, it happens quickly. Within a quarter or two, things could look completely different. It's why the Fed has kept the night rate paused at 5.5%, because the last thing that they want to do is break the labor market entirely, which is possible, if they're not careful. They also go on to talk about how inflation's falling. Then they go on to the consumer, which we've made 2 videos about in the past week, pointing out how the financial stress that businesses have been feeling has now rolled over to the household sector, which happens in the later stages of a tightening campaign. ING writes this: spending is holding up, but the outlook is deteriorating. In terms of the activity side, the 0.2% month-over-month rise in real spending suggests that we are on track for 2% annualized GDP growth in the fourth quarter. However, the weakness in real household disposable incomes seen in the chart below remains a key concern for growth in the early part of 2024. The data suggests stagnant real household incomes over quite some time now. So far, this has been offset by the running down of savings and the use of debt to fuel spending growth. However, tighter credit conditions and higher borrowing costs are likely to weigh heavily on the flow of credit to the household sector, while there is growing evidence of pandemic-era accrued excess savings being exhausted for an increasing number of people. Credit card delinquencies are on the rise, while student loan repayments are only adding to the financial pressure on millions of households. And again, they highlight early 2024 as when things are going to come to a head. And with that, they say this: we have modest growth and cooling inflation and a cooling labor market, exactly what the Fed wants to see. This should confirm no need for any further Fed policy tightening, but the outlook is looking less and less favorable. Note, a majority of Federal Reserve districts report flat to lower activity in yesterday's Beige Book, and we expect rate cuts from the Fed from the second quarter onwards. We are currently forecasting 150 basis points of rate cuts in 2024 with a further 100 basis points in early 2025. So look, it's all up to the Fed now, folks. This is the end stage of this cycle. The longer they hold out, the worse the downturn will be. Now, with regard to housing, one thing's obvious. We need more supply. We need at least another 400,000 listings to get close to where we were in 2019, around 1.1 million active listings. Well, to do that, there's 2 schools of thought. The first is that with tighter policy like we've had, it'll force a downturn, cause a period of forced selling, which Jerome Powell's spoken about, which would obviously work eventually. But the second school of thought is if the Fed does begin cutting sooner than later, like ING proposes, and avoids a hard landing somehow. But what they say is that because the economy has already cooled enough, affected enough homeowners, once mortgage rates start to fall, it could cause a big boon in home sellers looking to sell and lock in any appreciation that they still have after they've depleted their savings. Because right now they're locked in with these lower mortgage rates, and are possibly like out of a job right now or having trouble finding a job of similar caliber that they recently lost. And that's why it'll cause, a boon in selling and bring active listings back up. So those are the two different schools of thought. Look, regardless what happens, we're getting closer, that's for sure. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.